Right. Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah, and our guest today is Milind Karmakar. Milind, great having you. Thanks so much for taking the time out. Milind, the, the most recent spate of chatter that I hear on the street is about the overextension at the broader end of the spectrum in a time when the world is looking to maybe avoid risk as well, where yields are moving up, where interest rates might stay higher for longer as per the Fed meet. And therefore, why should these stocks not correct a lot more than what they have done in the last few days? I would love to understand from you, how do you look at that problem from your prism?
Okay. So, as you know, Neeraj, I predominantly look at the longer term, but let me just tell you that in the last few months, as you rightly said, that the market has moved up significantly higher. So, in last, say, if you look at the financial year, market is, I think, up by 14-15% or even higher than that. Now, the issue is that whether we will see a correction coming in, or is a correction, let me say, is a correction necessary? So, yes, to some extent, normally whenever the markets go up the way they have in a shorter period of time, there is always a correction. It's basically a cooling off. What will drive it? Very difficult to say as of now, because interest rates, frankly, yes, though they will remain high for some more time, at the same time, we are probably at the fag end of interest rate hike. So that may not be the reason why the markets could correct big time. Global markets, as it is, are not in a great shape. Predominantly, I mean, I'm talking about the economies. So there is a possibility that they may stagnate for some more time. But as far as the Indian markets are concerned, I think the key sort of impactor of the markets in all probability will be political situation in India, or what the media talks more about politics, and this will impact the sentiments and therefore the markets. But yes, the markets are likely to correct in the short.
Okay. Yeah, and I know you look at the long term, so therefore I was not essentially asking you for a small prediction of sorts, Milind, but good to get how you're thinking about it. Okay. So,
yes.
Milind, would you believe, so if indeed the markets are corrective or not, let's say in an uptick, if you will, is there a chance that the broader end may see a steeper move downwards, specific pockets? Because in the last 4 months or 5 months, we've seen the broader markets make a much sharper up move than what the large caps do.
Absolutely. Very true. And yes, I completely agree with you that there is a possibility of a sharp correction in the broader markets, more than the benchmark.
Okay. Now, within that narrative, Milind, there are pockets of strength wherein the companies are talking about pretty decent growth despite the global environment. And some of that is also fueled by policies within India, demand within India of specific pockets. Now, how are you balancing your portfolio? I've seen tweets from fund managers talking about fairly large cash levels currently to take advantage, so on and so forth. So one, are you playing this tactically? And two, within the pockets that you are constructive over the long term, are you fully invested?
So we are almost fully invested. I can say we are at about 5 to 7% cash. Rest all is fully invested. The rest all is invested. We continue to be invested predominantly in consumption, which has been my favorite theme, and it in all probability will continue to be that. But when I say consumption, as you know, that I not only talk of retail or FMCG or things like that, but we also include the financials, hospitals, insurance, and companies or the sectors which are directly benefited by rising per capita income. So that constitutes nearly 70 to 80% of the portfolio. And balance, of course, of late, in the sense that last 6 to 9 months, we have invested in manufacturing. And we continue to hold them. And you're right, these are predominantly those segments in manufacturing which are likely to benefit because of government policies. So yes, there is a risk also that of assuming that there will be a continuance in government policies post-elections. So that is the reason why I see some kind of a correction could come in these type of sectors where there is which are doing well because of government orders.
Yeah. But you're not tempted to take advantage. You kind of playing the long game.
Yeah. So if I go back in 2003, as you know, that government gave a big push to the power sector, and because of that, power ancillaries as well as infra companies did very well. Like cap goods index between 2003 to 8, if I'm not mistaken, went up by 28 to 30 times when the market went up 6 times. So this time as well, I think the cap goods sector, predominantly the power as well as the railway sector, is likely to do pretty well. But at the same time, last time consumption did not participate. But this time, as we are at the cusp of 2,000, rather beyond $2,000 per capita, the next move, which we believe will be to take the per capita income from $2,000 to say $6,000, consumption will be a big participant in this rally.
Got it. I was going to save that for the end, and I will come to that because I would love to understand how you think about that aspect particularly. Yeah. But so I'm just trying to get clarity. You are not tempted to take tactical advantage of a potential possible corrective move in manufacturing themes?
Sorry, can't hear you.
Okay, can you hear me, Milind?
Yes, I can hear you.
Okay. I'm saying you are not tempted to take advantage of a potential possible correction in the manufacturing end of the spectrum ahead of elections currently because you believe in the long term. Is that a fair summation?
So when I say I'm invested, as I said that I'm about 12 to 15% invested in manufacturing, and I have 5 to 7% cash. So if the fall is significant, I will go ahead and invest the balance money in manufacturing. I don't think we will add anything to consumption at this juncture because we are already adequately invested in consumption.
Yeah, no, I meant manufacturing, to be honest, because that's where...
Yes. So manufacturing is where we will put in additional cash.
Got it. Okay. Now,
as and when the correction comes.
As and when the correction comes. Yeah, very difficult to time that, I must say. Almost any given time, let alone now. Milind, there is a bit of... I would say most bulls on private banks have kind of the conviction hasn't quite paid off to the T, if you will. I was looking at a chart from November 2020. In fact, the PSU banks have, as a basket, have outperformed the private sector banks by a country mile, if you will. Now, my question is, and we've seen the latest set of, how do I say, commentary that came in from the largest bank and how that has led to a bit of a decline there too. Now, my question is, what's happening here, according to you? Do you believe that this market will at some point of time take cognizance of the potential growth ahead? Or do you believe this is the new normal in terms of valuations for private banks as well? And therefore, it will only be an earnings growth-led move whenever it comes?
So, yes, it will be an earnings growth. I doubt whether there will be a further PE expansion in private sector banks. But I also doubt whether there will be a PE expansion in public sector banks. And within growth, I think private sector banks will grow faster than public sector banks because predominantly the growth will be driven by personal loans or retail loans rather than wholesale loans. And that is where private sector banks, in all probability, will score over public sector banks. Though we have a public sector bank in our portfolio, but at the same time, our focus predominantly continues to be like most of the, let's say, the old fund managers. We continue to be bullish on the private sector banks more than the public sector banks as of now.
So, Milind, would it be fair to say that the PSUs, in some sense, have narrowed down the multiple, the price to book or price to adjusted book or price to earnings, whatever you look at it, to the maximum possible? And here on, both sets will move as per the earnings growth, you reckon?
Yes, that's what I believe.
Okay. Okay, the other aspect is insurance, right? Long-standing argument of under-penetration, continues the last multiple years now. We haven't seen these stocks virtually go anywhere. How long could the wait be, and what could trigger a performance of the stocks independent of what the businesses do per se?
Oh, sorry, I missed your first.
I'm talking about
first half of
insurance,
the-
Milind. I mean, for a
insurance,
long
yeah.
time, the stocks haven't gone
Okay.
anywhere, right?
Very true.
So,
Very true.
what gives here?
Okay, so insurance is an underpenetrated market even now in India, significantly underpenetrated. Though there are laws, especially when it comes to vehicle insurance, people are still, especially in two-wheelers, not very willing to renew, especially at the lower end of the strata. But things are changing now, and it's all again a per capita income game, because it's very simple as far as whether it's medical health insurance or whether it's even vehicle insurance. As the as more and more people start earning more and more, their need for insurance, higher and higher insurance goes up, both in what they possess as well as their life and health, and that will drive insurance. In the shorter term, there has been an issue, especially because of COVID. First of all, India was underpenetrated. On top of it, there were a lot of claims which came on these companies because of COVID, especially in health and life. And at the same time, the vehicle sales also fell significantly. And that is, if you look at all of this, the impact on insurance companies for last 2-3 years can be understandable. But beyond this, I do believe that it's a great long-term story. And if you talk to insurance companies, they're quite comfortable saying that the opportunity is there for them to grow at about 16, anywhere between 15 to 20% over a very long period of time. And these type of businesses do definitely well over a longer period, and that's what we believe in. So if I'm holding insurance companies in the portfolio, I will definitely continue to hold.
Got it. Okay. Now, Milind, please help us understand, how are you thinking about this per capita GDP growth from where we are to where we will be, say, 5, 7, 8 years down the line? Multiple different countries study throws up multiple different kinds of observations. How are you think about it in the Indian context?
So, our observation has been that the growth from $2,000 to $6,000 happens quite rapidly, anywhere between 5 to 10 years. But so I think in our neighboring countries, the longest wait was for Malaysia, but there were a lot of political issues there, and maybe that was one of the reasons. But in India, we do believe that this move from $2,000 to $6,000 or $6,250 can happen pretty rapidly. And the reason why I'm saying $6,250 is that for a family of 4, what it means is that the per capita GDP would be $25,000, which is the poverty line of United States. And if the entire country goes above the poverty line of United States, the kind of growth which you can see in consumption or anything to do with spare income can be phenomenal. And that is what we do believe in, and that is what we think is likely to happen, or is likely to drive the economic growth as well as the stock market growth in the next 5 to 7 years.
Okay. There is this lot of talk of the K-shaped curve there, and how that end is actually growing faster. So luxury cars, luxury watches, etc., will probably be the bigger beneficiaries of this uptick in per capita, though that end is already trading at the higher per capita any which way. So just trying to understand, one, how do you think of that argument? And two, within the lower strata moving higher, what is the best placed discretionary consumption theme or themes according to you?
I think hospital, pharma, and insurance. So these will be the themes which will benefit significantly in the lower strata, apart from the FMCGs and things like that. But these are themes probably which people are not looking at with a view of rising per capita income. But if you don't have enough income to survive, there is no question of you using a medicine or going to a hospital for health reason. And unfortunately, that is what is happening in India. So hospitals, pharmaceuticals, as well as insurance companies are likely to be big beneficiaries of that.
Now, viewers, I'll tell you something about Milind Karmakar. Even he started looking at a fashion retailer. This was way back in maybe 2000, 2001. And he's tracked it for 21 years, probably stayed invested in that for maybe 20 years, and has, doubled, tripled, quadrupled is the wrong term, multiplied the wealth by number of times. So we know that he can actually think really long term. Milind, I would love to know, do you think a theme like hospitals can be that kind of a multi-year multiplier story, or is it a slowly grinding higher kind of an investment theme?
So initially, all these companies are, as you said, slow compounders. But over a longer period of time, since the opportunity is large, because what I look at is opportunity. And that is where the hospitals do fit in as a long-term opportunity. So yes, I am looking at hospitals with a 10, 15-year view at least. So yes, if someone has that kind of a patience, like, even in retail, there were times when for 5, 6 years, the stocks did nothing. And but they have returned phenomenal returns over a longer period of time. So that can happen to hospitals also. So there is something, what I suggest is a core portfolio, or people say a coffee can portfolio, which you review once every 1 year or once every 2 years, and just sort of analyze it, that the thought process by which you had invested in the stock continues to hold or doesn't continue to hold. Because, thinking long term, there is one thing that, yes, you do believe that these particular things will play out, but at the same time, there could be changes. There could be changes in government policy. There could be a lot of other changes which can come in. So one has to look at them, but I think once a year is more than sufficient. Otherwise, you don't look at the stocks. And as long as the opportunity is there, you continue to hold. So if you're that kind of an investor, then part of your portfolio can definitely be in these stocks, whether it's pharmaceuticals or whether it's hospitals, or even for that matter, insurance.
Got it. Well, in my final question, and somebody who thinks like you very long term on the portfolio side, spoke about media with me, about how the last 15, 16 years, the space has gone nowhere, the industry is consolidated, so on and so forth, and rising per capita might also mean the ability of these higher advertisement revenue, so on and so forth again. Any thoughts on media at all?
So media, frankly, is a fast-changing world because of technology. So ultimately, what will rule, very difficult to take a call, whether the OTTs will do well or whether the existing television channels will do well. It's very difficult to take a call. A small exposure is fine, but beyond the limit of big exposure in media, at least as of now, I would probably avoid.
Got it. Fair call. Milind Karmakar, always a pleasure talking to you. No different today. Thank you so much for taking the time out.
Thank you, Neeraj, and we'll definitely catch up.
Most certainly. And viewers, thanks for tuning into this edition of The Talking Point.